What's up, gangsters?
Gangsters?
The mighty, mighty Pound. All my Pounders are in the house. Cliff Peebles representing as he always does. Roger Weatherford is in the chat. 200 comments already in the live chat. We haven't even said one word. I love the vibes. You feeling the vibes, Mike? MK is here.
Overfeeling the vibes.
MD is here. Who else is lurking? Caro is here. Hi, everyone. Hi, lurking Caro. Kamikaze Keebler in the house. Who else? Sean is here. Dave Airy. What's up, man? Marcus is in the house. Nicole's in the chat. Duncan and John are behind the scenes, controlling all the sounds, all the graphics. We appreciate you guys. Shout out Nicole. Shout out Sean. All right, we have a sponsor tonight, Michael. Tell us who's sponsoring. What are your thoughts?
The company is Crane Shares, and I want to let you all know that Ben and I did a Talk Your Book episode coming out on June 19th on Monday with this fund right here called Clip, as they call it. This is
what is Clip?
This is KWeb with covered call overlay. Ooh. And we went pretty deep. Like, this thing is distributing 4.5% a month. It's like a 56% annualized income stream. So I'm like, pump the brakes. How is this happening?
That can't
so
last.
if you have questions, I have questions, and we got into it. It was good. It was a good one.
Okay, so where can people listen to that? On the Animal Spirits stream, on the Animal Spirits podcast feed, and that's when is that?
Monday morning. It was a good one.
Okay, very cool. Shout out to Crane Shares. Thank you guys for sponsoring the show. We appreciate it. We have so much to do tonight. Let's start with the technical bull market, and I think it went official today. Do I have that right?
I think it was Monday. But whatever.
All right.
Yeah.
Throw up this chart real quick. Let's fill people in on what we're talking about. This is a 1-year S&P 500 return, but off the lows in October, we are now 22% above that October 2022 low, which triggers what you would refer to as a technical bull market. And I mean, first, let's start with this. Who would have thought?
Not me. Not
me. Okay. We got some stuff from Steven Suttmeyer, one of my favorite technicians. Steven is the chief technical strategist, I believe, at Bank of America. He notes the S&P 500 up 20% from the 2022 low, and he notes FOMO catches on as the S&P moves into a cyclical bull market. So I'm just going to quote Steven, and I want to get your reaction on the other side. SPX has climbed a wall of worry. Many key market indicators have flashed bullish backdrop signals throughout the first half of 2023. The move on SPX above 4,200 has triggered a fear of missing out rally, which has taken us into a cyclical bull as a 20% market rally off the 2022 low. So this is the important part. Cyclical rallies in excess of 20% can persist. This is the 27th bull market of 20% or more that was triggered on actually June 8th. Going back to 1929, these bull markets have lasted 33.6 months on average, and it's an average return of 114.4%.
Wow.
The year after the SPX, when I say SPX, guys, that's the index itself, so not the ETF. The year after the SPX enters a new cyclical bull shows the market is higher 65% of the time, and an average return of 9.4%, a median return of 14.1%, and that would equate to SPX 4,700 and then SPX 4,900 into June of 2024. Let's throw this chart up really quickly. These are the cyclical rallies of 20% or more that do not get interrupted by a decline of 20% or more from 1950 till now. And Stephen notes that if you forget about 1929, if you just focus on the cyclical bull market since 1950, the modern age, these types of rallies have lasted on average 53.9 months. And the average return is much higher, 155% on average. And the year after the S&P goes into one of these cyclical bull markets, we're higher 92% of the time on an average return of 19%. and a median return of 17.8%, which again would put us at 5,100 in the S&P or 5,060 respectively into June of 2024. What are your thoughts?
Few thoughts. Number one, I was speaking about this with Ben today, that a lot of the economic leading indicators are flashing red. For example, leading economic indicators are sharply negative, going the wrong direction, which has always, a recession has always followed. You've got
What do you do? You listen to the technicals or the economics?
You've got a severely inverted yield curve, which again has always at this level led to a recession. My bias is to listen to the stock market. Doesn't mean it's always right, but we've used a lot of Ryan Dietrich's stats on TCAF over the last year and a half. Anytime you had this retracement, then that, all of the price indicators that we had used have come true. They didn't have to. We weren't saying it was foolproof, but Ryan showed if this, then that, 100% of the time it was higher 12 months later. A lot of that has come out. So price has been right. However, we were talking with Jill on TCAF last week, and I hesitated to say that we're in a bull market, even though we are. What I was saying is the bear market is over, and this is a nuanced tape because the moment you say we're in a bull market, which we are, doesn't mean it's going to last forever, doesn't mean new highs are inevitable.
No, but it happens. Statistically, it happens.
Doesn't mean we can't roll over, but we are in a bull market. Again, it doesn't mean it's clear skies ahead. Risk is never off the table, but we are in a bull market. Fact.
This would be, if we fail here, that would be quite a head fake. Maybe not the biggest that we've seen, but that would be something special. Let's do this from Ari Wald. I have a couple of charts. So one of the recurring themes that we've been talking about all year or very recently is that, a lot of people will say, well, the market has such narrow leadership, therefore the rally is doomed to fail. Ari Wald has done some work, and his bias is to say that there's going to be a catch-up trade, not a catch-down trade, which means leadership stocks could take a break here. So the FANGs and the big growth names could take a break here, and the rest of the market catches up. And that's how that narrowing ends up resolving to the upside for the overall market. So this is Ari. We think internal breadth is positioned to expand over the coming weeks because meaningful breakouts have developed in the areas that have limited participation since the February peak, small caps most notably. This is confirming our view that the next market rotation should be driven by bullish catch-up rather than bearish catch-down. Growth should remain a core portfolio position through this tradable shift, and we believe SMID-cap growth, which is small and mid-cap growth, offers an attractive balance to both themes. So Ari has, let's put this first one up. Okay. Here's what we're looking at. This is the S&P 500 at a new rally high last week with only 53% of New York Stock Exchange stocks above their 200-day moving average. He notes that while market strength has been narrow, the internal breadth is positioned to expand over the coming weeks. How does he get there? Number one, the S&P's trend has reversed higher following broad-based collapse in 2022 when only 12% of New York Stock Exchange stocks were above their 200-day. He thinks the selling has narrowed, and in turn, the buying has broadened. Number two, meaningful breakouts in small caps and value that have done very little since the old February high. Number three, it's 8 months since the Q4 2022 bottom. The market is at a point historically consistent with expanding breadth off a cycle low. So that's how he gets there. And here's the second chart really quickly. So we're looking at the Russell 2000, which is the representative of the small caps. The Russell relative to the S&P 500 are the equal weighted, so that's the middle pane, and that's a bullish divergence. And he notes the Russell 2000 can be considered a proxy for internal breadth due to the index's correlation to the percent of New York Stock Exchange stocks above their 200-day. The Russell has completed a 3-month base. It's emerged back above its 200-day. We believe this supports our view that internal breadth is positioned to broaden, which would be a bullish divergence based off the index's relative ratio, and that adds to his conviction. So if you get this shift higher in small caps, you can look at that as a proxy for just overall market participation, and he thinks that gap is about to close, which is why the opportunity is now in small stocks and medium-sized stocks, And a day like today, that's what it looks like to me.
Last couple of weeks. So the last 2 weeks we spoke about just this idea of the market, the rest of the market catching up instead of the leaders catching down. And you're seeing that RSP, which is an equal weight, IWM or the Russell 2000, as well as mid-caps, IJH or whatever index you're using. All of them are at the highest level they've been since March 2023. I've got more on the rally broadening in a minute, but not everybody's buying it. Somebody who has not capitulated is Mike Wilson. He's from Morgan Stanley.
Yeah.
He said, quote, more are declaring the bear market over, officially over. We respectfully disagree due to our 2023 earnings forecast. He expects earnings to drop 16% this year before a sharp recovery in 2024. I don't see it. Analysts are actually raising earnings estimates. So this rally has been driven by...
just said this?
That was yesterday. So the rally has been driven by two things. One, we keep saying positioning. People are offsides expecting worse. And earnings have been good and estimates are coming up. So chart on, please. There we go. So this is analysts raising global estimates since April. So this didn't happen just yesterday. It's been going on for a few weeks. What he's saying is he thinks that this is analogous to the 1945, 1949 boom bust pattern. On top is what happened there. You got that vicious rally and then it failed, made a new low before, making new highs. And this is where he sees us today. So,
I mean, the pattern matches the pattern, but like how hard did he have to work to find this 1945 to 1949 analogy? Like how many market eras did he have to comb through? And it feels tortured to me.
Yeah, this is tough. So we lean on historical data a lot, although there's a million caveats. Nothing is ever, this cycle is not like any other cycle we've seen. But I am reliant on, 11 times this happened. All right, it's not 100 times, but at least, it's not zero.
So he found one pattern that matches,
this is
we're
tough.
citing 92% of the time stats
about
cyclical bull markets beginning. Mike Wilson was really good last year. He was
bearish early. He was bearish early. Credit
he was
him.
bearish early in 22, not late in 22. And I think correctly, he was open to the possibility of a bear market rally, which the October, rip looked like it might be. But strategist is a fucking hard job because if you get the down right, it doesn't matter if you miss the up. I mean I don't think he foresaw the NASDAQ rallying 30% this year. I'll tell you
I
that
don't
much.
I don't think a lot of people did, but this seems like he's digging in his heels. And listen, I guess credit to conviction, I guess. And if he's right, hell of a call. We'll see. All right, let's keep moving. So the chase is on. This was in Barron's over the weekend. I know a lot of people's spidey senses gets tingling when Barron's does something, but whatever.
I wish they wouldn't do this.
It is what it is. Yeah, I don't like it either. So we spoke about retail investors being stubbornly bullish for a long time, and that's over. It flipped. So chart on, please. This is from Jim Bianco. On top, you've got the bears in blue, and you've got the bulls in red. You see a really good flip, and the bottom pane is the difference. So the difference between bulls and bears is at the highest level since, what is that, November 21, give or take. Yeah. And so there is a catalyst. Again, we just keep talking about fundamentals don't matter in the short term. They lit the fuse potentially for some short covering, for some people to start getting more constructive. But now you've got all of this money in money market funds. And Evercore says, quote, a mountain of money in money market accounts is fuel for an equity momentum market move and could accelerate the arrival of our year-end price target of 44.50 as early as July 4th, whatever. Charts, please, John, just scroll through these. So as soon as...
What is this?
This is money market.
The amount of money in money market funds?
Yeah, so as soon as this went parabolic, and, money should move to money market funds with 5%. I totally get it.
Right. That's not irrational.
No, not at all.
That's not fear. That's greed. That's a high yield.
No, this is reasonable. So I'm not hating. I have money in money market funds. But as soon as everybody wanted safety, boom, the S&P shoves it where the sun don't shine. All right, Bloomberg keywords for bull market. Next chart, please. So, yeah, listen, you've got that. You've got a new VIX regime. The VIX is at the lowest levels since 2019.
Is the VIX 13?
The
Vol smash.
Was up a little bit today, but
remember we used to say vol smash.
Yeah. So there it is.
Man.
You've got short covering rally. Excuse me. This is from Goldman.
Let me take a look at this.
That is people covering their shorts. Up is more shorts, down is less.
So this is U.S. listed ETFs weekly short flow percentage. Okay, all right.
Yeah.
I believe
However, at the risk of sounding like euphoric, this is from Bespoke. The S&P closed 2 standard deviations above its 50-day for 5 straight days. Prior times it reached these levels since 2022 ended up being short-term peaks. So,
all right, short-term pullback, 12-month rally. I could live with that.
I don't think it would surprise anybody. But what's interesting, Josh, is retail is starting to get bullish, which, listen, it's been a hell of a move. I'm surprised it took this long. Institutional money is not really budging. Next chart from State Street shows the State Street. So the one on the left is what we just showed, the Bull Bear AI. That's from AAII. The one on the right is the Institutional Investor Risk Appetite Index. I don't know exactly what's in here, but you get the point. I mean, institutional money managers are not bullish.
Here's the thing with the AAII U.S. investor sentiment, bullish, bearish. Honestly, this is a concurrent indicator. I could predict this. The easiest way to know what this is going to say next week is to just look what the stock market does this week. It is the epitome of noise.
Well, yes and no. I mean, you're right. It definitely follows stocks, not the other way around.
People say it matters at extremes. I feel like it's always at an extreme.
No, it's not. It's not. What matters was coming into the year, as we've said ad nauseum at this point, retail, economists, money managers, institutional investors, and allocators, everyone was bearish. And that was the setup for, that was the spark that did it. So next chart shows the fund manager sentiment. I'm sorry, my bad. I skipped one. So fund managers, the most crowded trade is overweight healthcare and cash. Most underweight trade is U.S. equities. These are people saying that they're overweight or underweight. So again, fund managers are still underweight, but at some point they're gonna have to chase. The next chart shows something similar. Again, I don't know exactly what this is showing, but you get the point. Tops are peaks, bottoms are troughs. And they're still bearish.
All right, so let's shake some people out. What put up the equity shorts.
So a bit of short covering here, as we mentioned. But yeah, there's still people are still
these are net short positions in the S&P 500 E-mini futures dropped from a record high. So the bottom is the high. All right, I got it.
And we've got the Fed tomorrow, so we'll see.
So underpinning the rally is better than expected results from some of the largest index weights, the individual stocks that make up the largest portion of the index. We got another one this week. Oracle just absolutely is dazzling people.
Credit to you.
With its cloud business. And yeah, we talked about the stock on the show in the 80s and 90s, and I was a buyer, and I'm still in it. I haven't sold it. Oracle reported last night, and the stock went crazy going into the print and after the close. Today the rally fizzled a little bit, but I think it's still closed up. This is directly from the report. Reporter covering Oracle. Cloud infrastructure revenue increased 76% to $1.4 billion in the period ended May 31st. Cloud application sales jumped 45% to $3. These are huge growth numbers. More than $2 billion in cloud capacity has recently been contracted by companies doing large language model development, said Larry Ellison. Oracle, so he's not the CEO, but I guess when they have amazing results, he likes to come back and chime in. Quote, Oracle's Gen 2 cloud has quickly become the number one choice for running generative AI workloads. That's an important statement. Oracle's cloud is newer. So the infrastructure built by AWS and Microsoft Azure, that's Gen 1 cloud. Oracle had the benefit of building its cloud in the AI era, meaning it is better suited or more purpose-built for the new shit. And that's an advantage as they go out there and sell and try to take market share from the old cloud leadership. And they are playing that up in the press to the extent that they can. Let's throw up this Oracle chart. Bang. This is year to date, and this is not a small company. This is a monster-sized, not quite a FANG, but
$315 billion market cap. Yeah.
Yeah, so this is some shit. So we got this one right, I guess.
You did. So this, Josh, I'm looking at like a long-term chart all the way back.
76% over the last year.
It failed
shit.
at its 2000 peak, which I don't put much weight into that, but it just blew right past it. The peak in 2000 was $230 billion.
Yeah, forget it. This thing's off to the races.
Gone.
Let's look at this versus the market and versus the Qs. This is back to the start of the year, January 2020. So Oracle is up 133% in, what is that, 3.5 years-ish? Blew the doors off the S&P and about doubled the NASDAQ. So this is like, and by the way, we don't have a chart going back this far, but this is historic highs. This is now breaking the 2000 dot-com peak. And Oracle was not one of these FANG stocks that had a great last decade. And a new CEO, Safra Catz, she didn't exactly set the world on fire in talking to Wall Street. And people looked at this like a legacy business, like a Cisco. Like, all right, Oracle, its databases, it'll just kind of grow with GDP. That's not the story anymore. Now the story is Oracle's cloud is a serious competitor to Microsoft, Amazon, and Google, and they are heavily involved in things like TikTok, which Oracle is the cloud provider for. And now the AI story is starting to hit this stock. So that's what's going on.
Know what closed above $1 trillion today for the first time?
What?
NVIDIA.
It did it? Okay. Wow. I mean,
So,
not wow.
I think this is going to be the worst year for active managers. Maybe not ever, but it's going to be bad.
If you're an active manager and you have a value orientation, which most of them do, good fucking luck.
Josh, it's not even value orientation. If you're not super long the mega caps, you're in trouble.
Right. And like the valuation that you have to pay for NVIDIA and now AMD. The SMH hit a new record high today, the chips. None of these stocks are cheap other than Intel,
tough.
which deserves to be cheap. All right. So all of this dovetails nicely with recession fears fading at the same time. And I know you alluded to that. You want to do some of these charts?
Let's roll. These are yours. So this is on top is month over month change in CPI. I think came in a little bit under expected this morning, but
Good enough.
Look at the bottom. It's just, we're heading in the right direction.
Yeah, we have a 4 handle on CPI, soon to be a 3 handle, we think. And that's that seemed elusive even 3 months ago. And now we're getting it. So this is a pretty key moment. And Kathy Wood had been talking about disinflation coming, and I'm not saying that call will be right, but 4 looks better than 9, 3 will look better than 4, and on some measures you will get outright disinflation on some of the components, not all.
Two interesting things happened today. Number one, the Fed funds rate closed above trailing inflation for the first time this cycle, which is important.
Wait. The Fed funds rate is now above the rate of inflation. Mm-hmm. Right. So they were saying like we have to get to a point where monetary policy is restrictive. Well, definitionally, you are here now.
I think tomorrow is going to be important. I'm going to be listening for what they're talking about the labor market. Because it's still super, super tight, not really having any impact.
Some stats from Sean on CPI real quick. CPI 0.1% month over month, plus 4% year over year, in line with consensus. But annualized CPI over the next 3 months is now at 2.2%. That is the lowest since November 2020. Energy was down 3.6%, which helped the headline number. Used cars and trucks still up 4.4%. That defies logic, but okay. Food up 0.2. The CME Fed Watch tool, throw this chart up, is now pricing in a 92% chance of no rate hike this week, tomorrow. CPI has declined 11 months in a row. That is the longest streak of CPI deceleration in year over year since 1921. So we had crazy high inflation last June, but every month since we're decelerating, and that's really the most important thing.
So interest rates broke lower on the announcement or release of the data and closed materially higher. The 2-year closed at the highest level since the March meeting when they crashed. So interesting. Maybe they're going to do it. Maybe they're going to calm inflation without a recession.
So it's kind of funny that just as the stock market is breaking out, all of the recession calls are being reversed. Mike Wilson, most of the recession calls are being reversed on Wall Street. The question is this price influencing the strategist's feelings, or is the market rallying because the economic data is staying strong and the recession calls are fading?
It's
like
both.
It feels like everything's falling into place. Earnings are rebounding, recession fears are fading, inflation is fading. What else do you want? Literally, what else do you want, right?
Mm-hmm. Yeah.
All right, this is just a roundup of some of the Wall Street economists who are pulling back on the recession calls. Wells Fargo's team of economists this week became the latest group to dial back the recession outlook. The firm now sees recession hitting at the beginning of 2024. We're not yet on the brink. Quote, while we still expect the delayed effects of monetary tightening, and tighter credit availability to dampen economic growth, the economy has proven to be more resilient than we anticipated. Yeah, no shit. As a result, we have pushed back to our economic contraction to Q1 2024. Wells Fargo is not the only one becoming more optimistic. Goldman cut its odds of a recession this year from 35% to 25% this week. Capital Economics teased it's pushing back its third quarter recession call. Bank of America economist Michael Batnick said there's an increasing path to a soft landing or mild recession. There's even a case for no recession, per what Goldman Sachs COO told Bloomberg this week. So this week, all of the economists on Wall Street are like, all right, actually things might be okay, at least for now. And that, again, that's coinciding with earnings beats, record highs in stocks, declining CPI. Like, I don't want to get like crazy bulled up, but like these are all the things that we wanted to see, and they're all happening at the same time. So if you are going to pull back your recession call, you have a lot of cover. Is that fair to say?
Yeah. I mean, it's a tough job. This was a very, very unusual.
We don't make fun of the people in that seat because we wouldn't do any better ourselves. We point this out just to say an economist screaming about a recession in March, by June could be singing a very different tune because A, the data changes, B, the sentiment changes, and they have a job to do. And the job is not to be right all the time, but to adjust their expectations based on data.
Here's the problem. They're looking at data that comes out with a lag by definition, and the market doesn't wait for the data. The market looks ahead. So it's really tough.
Right.
All right. I shared this chart last week. The S&P 500 minus the equal weight on a rolling 60-day basis was reaching extremes, as we mentioned, a million times at this point. Sharp pullback.
Which is the catch-up. This is the catch.
Yeah.
RSP is equal weight S&P ETF.
Yeah.
So the catch-up trade is working, and the leadership stocks are not the only show in town.
Right. And then you saw a record weekly inflow for RSP. I'm sure this is some model portfolio, I'm guessing.
Somebody's making this bet. Yeah.
Noteworthy there. The percentage of Russell 2000 stocks at a 50-day high is at the highest level since, man, it's been a long time. How about that? Since early 21?
Yeah.
And then same thing, percentage of Russell stocks above their 50-day moving average, broadening out. Rob
this
Anderson.
Is what we. Yeah. So wait, before we go further, leave this up. This is what we mean by the chase is on. And I talked about this the other day. When the Russell starts rocking like this after 6 months of large cap outperformance, this is not people necessarily bullish on each of the specific stocks in the Russell. This is somebody saying, "Get me long. I don't give a shit how. I need beta today." That's what moves that index. Not like all of a sudden the analysts covering the 2,000 companies in there all getting bullish at the same time. That's not what it is. It is the chase. All right, keep going.
All right, Rob Anderson of Ned Davis shows the percentage of stocks by sector above their moving averages and stabilized to going up.
Yeah.
Going up. Yeah, industrials are super strong. And then the New York Stock Exchange Advanced Decline line is also showing, it's not just 5 names or 6 names or whatever it is.
Yeah, I want to give a lot of credit here to our friend JC at All Star Charts. He has been actually screaming for months now.
A year.
You're not looking at the right data if you're talking about narrow leadership, because that was yesterday. Today, there are a lot of things going up, and he was very early to that. And he could have been wrong. It could have reversed, but it didn't. And JC strikes again. So lots of credit to our boy. Let's just do this thing on. So everything we've been talking about is good. So let's just throw one thing into the mix that's maybe not so great, or maybe it is great. Maybe it's what we needed. The mass extinction event for startups is underway. This is a tweet from Tom Lavero. Do you know who that is? Mm-mm. So he's like supposedly an influential venture guy. I've not heard of him, but his tweet kind of went, and he said, "It is a news footnote most of the time. Don't be fooled. The market has changed. Funding announcements get lots of headlines. Bankruptcy filings less so. Apparently, there was a venture-backed startup called Plastic, which filed for bankruptcy." And then the other part of his tweet was prediction. He made this prediction in January. "There's a mass extinction event coming for early and mid-stage companies. Late 23 and 24 will make the 2008 financial crisis look quaint for startups." And then he does a whole thread, which it's enough already. But to his point, we pulled this chart from the Journal. Venture investors get less generous. This is U.S. venture capital deal activity by quarter. I don't think the second quarter will necessarily be a recovery, but maybe I'll be wrong. Maybe this will be the bottom. Venture-backed businesses in the U.S. raised $346 billion in venture capital in 2021. Startups in the U.S. only raised $37 billion in the first quarter of this year. That's down 55% from Q1 22. So a severe slowdown in people wanting to make bets on venture companies. What are your thoughts?
Yeah, it's coming.
It's
SoftBank.
Here. It's not coming.
It's here. SoftBank just prepared a new round of layoffs, which is not super surprising given all the spraying that they did in 20 and 21. One of their companies, this is a great headline, the $500 million robot pizza startup you never heard of has shut down. SoftBank gave, in 2018, SoftBank gave them $375 million.
Yeah, here, just light this on fire for us.
At a $2.25 billion valuation, this company raised $445 million in total, and poof.
Stupid question. All pizza is delivered. What? Am I an idiot? Why would why do I care if it's a fucking robot or not on the truck? I really don't give a shit. Just bring me the pizza.
I don't know anything about this.
Do Japanese wealthy investors know a lot about the American pizza market? Like, I feel like I could have. This is an area where I could have earned some consulting fees if they wanted to call me from Tokyo, so I could explain to them that we don't give a shit what's on the truck or how the pizza's made. It just has to be good.
But. I am seeing who is I think it's Renaissance. Who's the Renaissance IPO index?
Yeah,
Renaissance Capital.
Renaissance Capital has IPO is the
the handle is at IPO tweet. So on the one hand, there might be a reckoning underway, but IPOs seem to be coming back. This is anecdotal, but I've just been seeing a lot more activity, a lot more tweets from this company.
Well, the venture backed funding won't recover until the IPOs start to flow again, and they sort of are green shooting a little bit.
So Solomon was on CNBC.
Can I pause this? A lot of people are commenting on the Supersonic shirt. They're feeling it.
Thank you.
So
shout to Dale Ellis.
So we're going to get another Supersonics team. Seattle's going to get an NBA franchise. Why wouldn't they call it the Sonics? They'd be crazy not to, right?
I hope so. They were robbed.
I hope they do. All right.
So Solomon said he expects capital market activity to pick back up in 2024.
Yeah, he better hope so.
So yeah, obviously talking is but I feel like he wouldn't say this if there wasn't at least a little bit of truth there.
I think Solomon's gone by the end of the year. How about that?
Yeah, it's not a bold call.
Spend more time with his record collection.
Not a bold call.
Are we through?
We're through.
We're through.
Kept it quick, kept it tight.
Super efficient. All right. I feel like there's a lot of information delivered in a very compact package. I hope we can do that again. All right. I'm pitching you this week. I don't own this stock yet, so I'm not talking my book, and I don't know if I'm definitely going to buy it. But there are a lot of small. So if you think there's going to be this catch-up trade, And if you think the Russell 2000 has a lot of ground to make up versus the S&P, and it does. By the way, even on valuation, the S&P is a 19.5 multiple, and I think small caps are 13. So if you think that's where the puck is going, then I think you're not looking necessarily for breakout stocks then, because there aren't many. You're looking for babies thrown out with the bathwater. And I have a candidate.
Why this?
All right. So this is Simmons First National Corporation. This is one of the oldest publicly traded banks. I think I read that they've been paying a dividend since the late 1800s.
No, it was founded in 1903.
So maybe since 1903, whatever. I think it's a dividend aristocrat, and I think they've been paying a dividend for 120 years, and that would make it one of the longest uninterrupted streaks of dividend payouts. I also think they've been raising their dividend for decades. Somebody, if you want to fact check me, you can. But here's the point. Let's pull this chart up. Here you got a double bottom forming. You could see that this stock got hammered in the pandemic along with every other stock. You can see that it had a shitty last 12 months. It's a regional bank. So, yes, of course it did. But this is not Silicon Valley Bank. They're in Arkansas. There is no tech in Arkansas. There are no startups in Arkansas. There are not people racing to put money into online banks there. I feel like this is a regional bank that just got thrown out with all the rest of them. But think about what this company has survived. Like literally World War I, World War II, Great Depression, disco. There's just a whole long list of things that this company has endured. And by the way, what have they been doing the last 3 years? Making big acquisitions and expanding outward into other southeastern states, buying big banks and paying a really good dividend. And as Steve Jobs liked to do, here's one more thing. Massive insider buying in this stock. Directors, the CEO. So I don't have this in an organized way, but let me just give you some of these buys. It started on April 28th as the other regional banks were getting pummeled. You had a director, Marty Castile, come in and buy 193,000 shares at $16. Excuse me, 2,000 shares at $16. He owns 193,000 already. You had a director buy 6,000 shares at $16.29. You had the executive vice president, Stephen Massinelli, buy 10,000 shares at $16.44. Then the CEO buys 12,000 shares at $16.50. Then another director, Eugene Hunt, back to back, buys 1,000 shares and 1,000 shares at $16.68, at $15.32. Then you had the executive vice president and chief credit risk officer buy 300 shares. You had the executive chairman buy 10,000 shares. So it's like one after another. It's a lot of stock being bought. 15,000 bought by the president and CFO on May 12th. And, again, this is not a bank that is in the epicenter of this like race to money market funds or panics. And I just think it's like, if you believe in this catch-up trade, these are the types of stocks that I would personally be looking for. And I don't buy a lot of regional or small cap bank stocks. So I just wanted to put this one on your radar, not telling people to run out and buy it, but just be aware there are always opportunities in the market. These types of situations are probably the ones that are going to work if this catch-up trade continues. Thoughts? You a buyer?
Nah.
What turned you off? Arkansas?
Well, I love Arkansas. If I was going to buy regional banks, and I did and I do, I would just rather own the ETF, which I do. I don't know why I would pick just one randomly. But technically it looks fine. All right, C+. All right.
I'll let you know when I buy it and when I sell it.
John, if you would please. So I've got a twofer. These both made 52-week highs today. These are both economically sensitive stocks. The one on the bottom has a giant asterisk. There is something interesting going on there. But the one on top is the most strongly correlated sector with GDP growth. And that is a breakout to a 52-week high. The bottom is like a subsector, I guess.
All right. So the top is the XLI Industrials ETF.
Correct.
Okay. The bottom is a stock or a subsector? Which is it?
It's a subsector.
Home builders.
Bingo.
Holy shit, I did it?
Yeah.
I did it?
Well, hold on. Credit to me. I give good clues. So
Dude,
the
you
most
you didn't give me that much.
most strongly correlated sector to GDP is a pretty fucking good clue.
You didn't give that. Josh is on fire.
The bottom one was good. But
You
chart
didn't
back
give me
up.
that
Chart back
much,
up.
bro. I'm
Chart back up.
killing it right now.
Chart back up. Look at that. So
Yeah. So what are you going to tell me now, tough guy? You got 525 basis points worth of rate hikes, and this is what the home builders are doing. What else? Like what? What else? What else you want to tell me? You know what I'm saying?
And so you've got that going on. You've got the IPO ETF turning up. You've got ARC turning up. The chase may be on, or it might not be, but it is.
ARC, and the Russell 2000, and the Nikkei, and and large cap tech, and home builders, and industrials. Whoa! What are you looking for here? Like, what else do you still need? It's tough. It's tough. And
you might get a 2% pullback tomorrow. Get another entry. Just kidding. Everyone's going to be scared.
We'll delete the show off of YouTube immediately. Hey, for those of you who have been asking, I am in Austin, Texas right now. So my backdrop is we have like a whole floor in the hotel that we're using for meetings. There's a whole meeting floor, and this is like one of the rooms. So amazing week in Austin. So I know it's only Tuesday. Amazing time in Austin so far. And tonight we're going to do a little Tex-Mex and ball out. We had an incredible day seeing clients. We saw prospective clients. We met some other advisors who are thinking about joining us. We've just been demolishing it out here. I love the city. And the city loves us back. All right. Thank you guys so much for watching and for listening. Make sure you subscribe to the channel if you have not already. Do us a favor. Throw a like on this bad boy if you had fun tonight with us. Thanks for all the comments in the chat. We love you guys. We miss you when you're not here. First thing tomorrow morning, brand new episode of Animal Spirits hits the podcast feeds. Thursday, we're going to do a little Ask the Compound with Ben right here on YouTube at 1:30. And a brand new Compound and Friends on Friday with some special guests. We're going to have a lot of fun there as well. Thank you guys so much. Have a great night.
Good night.